let's address this concept of the combined approach, introduce you to it here. This concept is going to be when the auditor combines the use of substantive procedures with analytical procedures. As we know, analytical procedures are it's the process of the auditor going through and using ratios and comparing account balances from period to period. Substantive procedures are actual actions you're going to take, like sending confirmations, confirming balances, observing, examining, doing things like that. So the auditor can do both of these. So whenever you see the term combined approach, that's what it's talking about here. We're doing both of these. As I said, substantive procedures are used to obtain evidence about specific assertions. And we will see all of this. If you want to see that, you want to jump to that. This is going to be in our revenue cycle, expenditure cycle, payroll cycle, all those cycles we've got waiting for you. Analytical procedures are used to obtain evidence about overall relationships between the account balances. We want to make sure that, okay, does everything make sense, right? Did revenue spike this year, but they didn't have a lot more sales, right? Does anything seem weird? Are there weird variances between what you're seeing? The combined approach is used when the auditor has a moderate level of assessed risk. See any questions asking that? Now you're quite aware. Using a combined approach will reduce the risk of reaching an incorrect conclusion. I mean, inherently, you're just doing double, right? Not double, you're just adding another layer of assessing. You're doing more to assess what could be happening. You provide better assurance, and it enables auditors to tell a more complete story. Just in general, just one more point here. I mean, you could be doing analytical procedures, and that could lead you to determine what accounts you should test much more using substantive procedures. So it works hand in hand. It works well. It's a good approach. It's a very nice approach. All right. Now let's talk about the effect on substantive procedures. So under a combined approach, tests of the operating effectiveness of controls and substantive procedures are both performed. You're going to test the control risk, and you're going to affect detection risk. We'll see that, talk about that. So obviously a big topic within the audit risk lesson. In a combined approach, the nature, extent, and timing of substantive testing, so of our confirmations, of our reconciliations, all that, is affected by the operating effectiveness of controls. So the more effective a control is, the lower assessed level of control risk. That's just, and makes sense, right? Because the more we can trust that, hey, the cash cycle process, the way the client processes cash, the better off chance we just won't have actual fraud or errors within cash. We have a lower level of control risk, and as control risk decreases, the acceptable level of detection risk, which detection risk is going to be the risk that you as the auditor detect something, that you miss something, increases, and the assurance required from substantive tests decreases. Conversely, as the acceptable level of detection risk decreases, the assurance that must be obtained from substantive tests increases. These back and forth inverse relationships, if they don't make sense now, we're going to drill them through and make sure you got them. Again, really going to drill them down in the audit risk lesson. The stronger a control, the more it can be relied upon, and the fewer the required substantive tests, or the lower the quality of substantive tests. And you may say to yourself, why don't we just do a bunch of substantive tests, and why don't we just do a bunch of tests of controls? Well, they're expensive. Expensive, time-consuming. In a perfect world, yeah, you'd absolutely audit everything. You would sample everything. You'd audit everything. We're dealing with the real world here. Costs a lot of money. Takes more time. And it is beneficial to decrease detection risk and also decrease substantive testing. And here's why. You may say, okay, and this is actually something I experienced when I was working in auditing. If you've got 100 transactions and it's as simple as dragging a formula down to test the transactions, even though you're only supposed to test, let's say, 25, because that's what the sample was determined to be. No, I said, why don't I just drag the formula down and it'll tell me if there's any variances with the other 75 transactions. Well, the person I was working with said, yeah, but then if there is a problem in those transactions and we didn't find it, because we technically tested that, we are now liable for that. So think about that for a second. If you say you only tested 25 transactions, because that's what you needed to do for a reasonable audit, there's no reason that would be bad to only test 25 transactions if that's what the sample said you should do. And we'll get into sampling in that lesson as well. But if you test the other 75 and you miss something, well, you're taking more responsibility for testing more transactions That's more liability for you as the auditor. Some interesting points to take into account, something I definitely didn't think about when I was studying for the audit exam. And only really came, when I got into the field and understood how it all worked. Interesting points indeed. All right, do some jumping jacks, stretch, flex a little bit. This is our last one. Get that energy going. And once we're done here, do some multiple choice questions, power it through. Let's dive right into some risk factors. The risks relevant to financial reporting include external and internal events and circumstances that may occur and adversely affect an entity's ability to initiate, authorize, record, process, and report financial data. Oh, this is a sentence if there ever was one, right? It just goes on and on. Consistent with the assertions of management in the financial statements. All this is just beyond wordy, right? I'm going to break it down. Any relevant risks. So these are our relevant risks. Some are going to be internal, some are going to be external, and they are going to affect a company's ability to deal with their financial data. Breaking that down: initiate, authorize, record. Basically, just there are risks that are going to affect how we can deal with our financial data, consistent with the assertions of completeness, existence, valuation, accuracy, all of those. Risks can arise or change due to circumstances such as the following. Again, all this is saying is these are just risks, right? These are just risks that could affect our engagement as a whole. What are our factors here? We've got the changes in the operating environment. Could be anything. Maybe the economy's getting a little more rough. Maybe your suppliers are charging more. Just changes in general. Maybe you are making new products. Super broad here, but this obviously could bring risks. New personnel. You get new accountants. They don't really know how it works around here. They don't know how to enter particular items, right? If you get new personnel, they don't know how to operate the machinery. In general, no matter where it is in the organization, new personnel are not going to have the same experience as old ones. New and revamped IT. I think that goes without saying. I think I can say that all of you listening to this probably have had some bad experience with new IT integrated into your company. Rapid growth, that you just don't know how to deal with that. If your company's rapidly growing, that's wonderful, it's great, but it's kind of hard to scale and be ready for that rapid growth sometimes. New technology could present risks there. New business models, products, or activities. Company doesn't really know how to manage these and navigate them. Corporate restructurings, I mean, gosh, there's a lot of risk there. We don't really know how we're going to continue to operate the same way. Expanded foreign operations, goes without saying that countries operate quite differently. New accounting pronouncements. Oh no, we have to account for leases completely different now. That's problematic. That's troubling. And lastly, changes in economic conditions. How are we going to make it through the recession? I don't know, but that's a risk. It's a risk. All of these are risks to keep in mind. I had a good time. I hope you did as well. Let's finish this out. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.